Thank you for watching this video. Today we will be doing technical analysis on the S&P 500 for the week ending Friday, September 3rd, 2021. And for this analysis, we will be using stockcharts.com. That is the charting service that I use and pay for, and I will leave a link to their site in the description box below this video. My name is Rodney Constable. I have over 30 years of investing experience, including over 25 years of experience trading stocks and options. I am a former financial advisor, a former vice president of a major mutual fund company, and I am the developer and president of Simple Market Signals at simplemarketsignals.com. The first chart that we're going to look at is an hourly candlestick chart of the S&P 500 that goes from August 2nd through Friday, September 3rd. And of course, each candlestick on this chart does represent 1 hour of trading. The two blue horizontal lines are set at 43.74 and 44.40. And I want to point out here on this chart how important these support and resistance levels have been, especially for the month of August, and how they help set us up for the new all-time highs that we've experienced over the last few days. So starting over here on the left-hand side of the chart on August 2nd, that was the very first trading day of August, and you can see we sold off on the second and the early part of the third, and this is where we undercut slightly this 43.74 level right here, if you can see where my cursor is moving on the left-hand side of the chart. However, as you can see on these hourly candles, we didn't have any closes beneath this 43.74 level, even though the tail of the candle right here slightly undercut that, and that set us up to go up to this 44.40 level, which acted as overhead resistance for a few days. We finally got above that, and then we can see here that we hit at that time a new all-time high, an intraday high on August 16th, where we had, following that, we had a couple of days of a sell-off. And then right here on August 19th, now this was super important right here, guys, because we slightly undercut the trading on August 3rd. So there is that perfect technical double bottom on the hourly chart. Much easier to see it on the hourly than the daily. So on the 3rd and then the 19th. But again, we didn't have any closes beneath the 43.74 line right here, right? None of these hourly candles, the body of the candle, none of those during the month of August closed beneath 43.74. So technically that was showing me how important this level was, but we can see where the tail of the candle slightly undercut what we saw, from a trading perspective on August 3rd. And that set us up for this rally here that has lasted over the last 2.5 weeks and taken us to these new all-time highs. Now, I'm going to, bear with me here, I'm going to back this chart up. I'm just going to back it up here to the month of the beginning of July, because I want you to understand how important this level was and why this 43.74 level is even there. So if we go back, and now I've got the chart going back to the first part of July, and you can see we first got above this 43.74 level for a few days in the middle of July right here, but then sold off and rallied back. And then once we got back above this, see right here on the looks like the 23rd of July, we have not had any hourly closes, right? No hourly candles have closed beneath this 43.74 level since the tail end, about the 23rd or so of July, all right? So that's why I carried this line, but you can see we pulled right back to this level on the 27th. We pulled back to it again on August 3rd. We pulled back to it on August 19th. So again, this is why I wanted you to understand why this 43.74 level was in there and just how important that was. So now let's go back to August 2nd, reset my chart here and get everything back to where it was. All right, so now we can see again, and now you really understand why this 43.74 level is so important, but also why on a go-forward basis, if we, at whatever point in the future, if we start to see trading either on an hourly candlestick basis or on a daily basis, if we start to close beneath 43.74, we know that the market, at least in the short term, is in trouble, okay? But this double bottom here during the month of August set us up for this super nice rally that we've seen over the last couple of days. Now, I do want to mention something really quick, and I didn't pull anything up. You guys can do your own query on YouTube. But during, over the last couple of weeks, right, I've seen countless videos out there. I just want to get this in real quick. Bear with me because we've got another chart to look at. But yeah, I've seen countless videos out there by people that are supposed experts. So the market's going to crash. The market's going to crash. The market, guys, please don't fall victim to those things. Okay, pay attention to the technicals. Let the market tell you what it's doing. Please don't fall victim to these emotional, clickbait type videos. Okay, I'm sorry, I'm on a little bit of a rant here, but it drives me bananas to see that at the same time the market is continuing to rally. I am not saying we're not going to get some type of a 5 to 10% pullback, over the next 2 to 3 months. It could definitely happen. All right, but this is why technical work is so important, because it helps cut through the garbage. And it helps you focus on what's real and what the market is telling us, not what people are trying to, their predictions and their theories or whatever. Okay. So anyway, with that said, let's move on to the weekly chart. Excuse me, of the S&P 500, and this chart goes back to the beginning of the year. So this now every candle on this chart does represent 1 week of trading. So the first thing here is for the week, the S&P 500 was up 58 basis points, if you can see where my cursor is moving. And right up here, that is this week's candle, of course. It came on lower volume, and we've seen the up week volume fall really since the middle of July. That's not completely atypical. When you get, the market moving up, oftentimes you get a divergence. This is called a divergence, right? A divergence. Can't talk today. When the market is going up and the volume is starting to trail off, you want to pay attention to that, because as we can see here, you get a trailing off in the volume on the up weeks, and then you get a negative week. Okay, so the fact that we've had some trailing off on the volume potentially sets us up for a negative week at some point over the next few weeks. All right, so just kind of pay attention to that. I always like to watch volume, so I would encourage you to do the same thing. Now, where we closed this week, of course, new all-time high, 45.35.43 is the new all-time closing high for the week, and that puts us 10.94% above the 40-week moving average. Of course, the 40-week is very similar to the 200-day moving average. They're not always exactly the same, but they're going to be pretty close. So again, we're almost 11% above this 40-week moving average. So if we were to have a pullback over the next month or so that brought us down to this 40-week moving average, that would be a 10+% pullback based on where we're sitting right now. Of course, keep in mind that we do have an ascending, right, an inclining, an upward moving 40-week moving average. So that pullback could, if, right, the market does roll over, and I'm not predicting it will, I'm just pointing out the facts that, if we get a pullback over the next few months to this 40-week moving average, you've got the 40-week moving up and the market moving down. So the total pullback, if that's all we did was pull back to the 40, could actually be less than a 10% pullback because of the upward trajectory of the 40-week and potentially the downward trajectory of the markets. Okay, so guys, again, stay in tune with the facts. This is why on my videos you will never see me, unless I really feel that there's a problem. But you're not going to see me going out there and try to scare you just to get you to click on something and and make predictions. The market's going to crash. First off, what does that really mean anyway, right? I've been at this a long time. If you want to know my background in financial services and all the securities licenses and everything I've held and everything I've done over the last 20 plus years in financial services, make sure you check out the video link in the description box below about my background. Because I am a financial professional, okay? And so I hope you'll keep that in mind when you look at my material, whether it's this chart or the other 250 or whatever charts that are on my channel. Go back and fact check my work, and I think you're going to see that I stick to the facts, and if there is something to worry about, I'm going to tell you. But there's nothing in these charts right now that other than maybe a trailing off of the volume, right? But even at that, even if we just got a pullback, it's not going to be that big of a deal more than likely, right? The last time we even had a pullback that undercut and closed for the week below the 10-week, which is fairly equivalent to the 50-day moving average, was clear back here in June. All right. So are we, potentially due for a pullback towards this 10-week, 50-day moving average? Absolutely. Right. It doesn't mean it'll happen, in the next week or two. It could, but you can see oftentimes here, back in August, we just checked right back to that level. We undercut it here in the middle of July. We had a couple of weeks, one which closed beneath the 10-week, and then we had the week right here, the next week in July, that traded for a few days below the 10-week and then closed above it. So these pullbacks to this area, which are 3 to 5% pullbacks at the most, it's pretty common, right? The market does that. But a less common move is going to be a pullback to that 40-week moving average. But even if it does happen, guys, that's a normal market action. It's a 10% plus or minus pullback in the market. That is not going to be catastrophic, and for a lot of people, that might actually be beneficial, especially if you've been sitting on cash or waiting for a pullback to put more money to work. So anyway, guys, thank you. Please make sure you subscribe to the channel if you're not already a subscriber. Thank you for watching this video, and I would encourage you to also just stick with me for another couple minutes. Pay attention to the balance of this video because I have some very important information to share with you. Let me ask you a few questions. Do you manage any of your own money, including in your 401k or your IRA? Have you ever found yourself out of sync with the market, underexposed when the market is rising, or overexposed when the market is declining? If you answered yes to any of these questions, please pay close attention to the balance of this video because it could be worth a lot of money to you going forward. Do you have a stock market risk management and trend direction system in place? Do you know the various risk levels in the stock market on an ongoing basis? Do you know when it's safest to be in equities? Do you know when it's most dangerous to be in equities? Do you know the direction of the trend of the stock market? My system is Simple Market Signals. Simple Market Signals is market-based. There's no opinions, forecast, or guesswork in Simple Market Signals. It took me over 20 years to develop Simple Market Signals. I developed Simple Market Signals by reverse engineering the stock market, and I studied the stock market over numerous time frames, including numerous bull and bear markets. And what I found is that certain conditions exist during various market phases, and then I created simple, easy to understand signals around these different phases of the markets. And the thing is, guys, that most people don't know about or have access to the data necessary to do the research that I had to do to create this model. Simple Market Signals is a proprietary stock market risk management and trend direction model. And Simple Market Signals is perfect for financial professionals and individual investors. There's two major components to the proprietary model. There's a risk level signal and there's the general trend indicator. Let's start off with the risk signals. The risk signals are simply green, yellow, and red. The green signal has the lowest equity risk associated with it. And what you're going to find is that most all upward progress in the stock market will be made in a green signal environment. Said another way, it is hard to make money in equities unless the signal is green. The yellow signal means there's moderate equity risk, and sideways to slightly up or down price action is very common during a yellow signal environment. The red signal has the highest equity risk, and the worst sell-offs, including bear markets, will happen when the signal is red. A quick review of the risk signals. The green signal is the best risk-reward ratio signal for equity investors, and what you're going to find is that most upward progress in the stock market will happen in a green signal environment, as we see here. The red signal is the worst risk-reward ratio signal for equity investors, and what you're going to find is that the worst downturns, including the downturn in Q4 of 18 and the bear market in Q1 of 2020, plus the bear market from 2000 through 03 and the bear market of 07 through 09, all of those are going to take place in a red signal environment. Now let's put it all together and see how Simple Market Signals could have helped you during the fastest bear market in history, which of course happened during Q1 of 2020. We had a strong stock market coming into 2020. So the risk signal was green coming into 2020 and remained green for the majority of January. We did have a yellow signal for about 2 weeks towards the latter part of January, first part of February. And then, of course, the risk signal went back to green. And then on February 19th, we hit what was at that time the all-time high on the S&P 500. Again, that's February 19th. And then things started to unravel from there. But think about this. Just a few days after the all-time high at that time in the S&P 500, on Monday, February 24th, the risk signal went yellow. And then on Tuesday, the 25th of February, the general trend indicator went negative. And that general trend indicator had been positive since October of 19, okay? So right there, just a few days after the all-time high in the S&P 500, the risk signals started to tell you that something was changing, that there was increasing risk in the stock market. And by Thursday, February 27th, the risk signal was red. And then, of course, the market sold off hard from there. So think about this, guys. I mean, you talk about stress testing my model. During the fastest bear market in history, that started just a few days after the all-time high at that time, the all-time high in the S&P 500, in 1 week, the risk signal went yellow, the trend indicator went negative, and then the risk signal went red, all in the same calendar week, actually within 4 days, right? Monday, Tuesday, and Thursday. So you talk about stress testing my model. Guys, I mean, this is the fastest bear market in history, and look at how simple market signals could have helped you during that time. With simple market signals, you will know what the risk level is and what the trend direction is in the overall U.S. stock market. And the proprietary model is based on S&P 500 data. The S&P 500 index really is the best proxy for the overall U.S. stock market. And it's the only index that has all of the data available that I need to run the model. And guys, it's not about beating the S&P 500. However, that is a possible outcome over time if the tools within the model are employed properly. It's about risk management and risk control. It's about controlling your risk exposure rather than letting the whims of the market dictate your future. The best fit for simple market signals is an investor or a financial professional with at least a 6 to 8 week plus time frame that they're focusing on. If you're a shorter term trader or a day trader, simple market signals may help you a little bit, but the reality is that the best fit between simple market signals and a subscriber is somebody that has at least a 6 to 8 week time frame or more that they're focusing on. These signals are delivered to subscribers in our weekly emailed newsletter. As part of the Simple Market Signals weekly newsletter, you will receive the proprietary risk level signal and charts on the overall U.S. stock market. You will also receive the general trend indicator signal and charts on the overall U.S. stock market. You will also receive a weekly recap of what happened in the U.S. stock market, including performance information and charts. And this is on multiple investments. So we cover small caps, mid caps, large caps. So you'll have a great idea of what's going on in the entire U.S. stock market across all capitalization. You will also receive technical analysis data and charts, so things that are interesting and educational that I think is important for you guys to know will be included in the newsletter on a weekly basis. You will also receive fundamental analysis data points on the S&P 500, so we look at potential earnings per share for the year, as well as the possible PE ratios and then price levels looking out to the end of this year, and then I generally go out to the end of the next year as well. So you'll have great fundamental analysis data to work with on the S&P 500 right at your fingertips every single week. You will also receive yield curve information and data points. So we look at the 2s and the 10s. So the 2-year Treasury note, the 10-year Treasury note, and then the spread, the differential between the 2s and the 10s. This information, guys, very few people know about it. Very few people watch this. This is so important to really get your head wrapped around because it affects so many areas of the financial markets. And you will also receive the proprietary risk level signals on all 11 major sectors of the S&P 500. So not only do you get the risk level signal on the overall market, but we also give you the risk level signal on all 11 major sectors of the S&P 500. So you can see what the risk level is underneath the hood on all of the individual sectors. And you will also receive sector performance information on all 11 major sectors of the S&P 500 over multiple time frames. So guys, you're going to get all of this, right? And it's going to make you so much more knowledgeable about the financial markets. You're going to be able to have a conversation with virtually anybody about the stock market, and you're going to be able to really understand things at a level that very few people do. And guys, you're going to get all of this for just $19.95 per month. That's less than 67 cents per day. I want to set realistic expectations. The weekly emailed newsletter isn't fancy. It's effective. It's plain text, no color, other than the charts, of course, and no fluff. But it's chock full of extremely valuable information week after week. And please note, due to international compliance regulations, you must be at least 18 years old and a citizen of the United States of America who is currently living in the U.S. in order to subscribe to Simple Market Signals. And again, this is just due to international compliance regulations. A subscription to Simple Market Signals is just $19.95 per month. It's billed monthly on your credit card. There are no contracts. You can cancel anytime, and your first 2 weeks are free. Sign up is quick and easy. Just go to simplemarketsignals.com. That's https://simplemarketsignals.com. It'll take you about 4 or 5 minutes to subscribe. It's that easy. Once you reach the website, the first thing you will need to do is accept the cookies. Please notice that due to international compliance regulations, you must be at least 18 years old and a citizen of the United States of America who is currently living in the U.S. in order to use this website or our services. And that is just due to international compliance regulations. All right, so to get started, all you have to do is click this green button, and that will take you to the product page. And this explains, of course, what you get with your subscription. And then just make sure that that says 1, because if there's more than 1 in there, if you have a 2 or a 3, you'll get multiple subscriptions to the service, and you only need 1. Click the Sign Up Now button, and that will take you to the checkout page. Once you're on the checkout page, fill in the necessary information, anything that is required, including the email address. Keep in mind that this is an email newsletter, so we will have to have your best email address on file, and make sure this box is checked, because that's how your email address gets into the system. So if that is unchecked, your email won't get transferred into the Simple Market Signals system, and you won't get your newsletters. So please make sure that box is checked. And then, of course, just double check, make sure that your monthly total is going to be $19.95 a month. Remember that your first 2 weeks are free, so your first renewal date will be 2 weeks after your subscription date. Fill in your credit card information. You will need to accept the privacy policy and check that box that says you've read and agreed to the terms and conditions. Click the Sign Up Now button, and it's that easy, guys. It's probably going to take you maybe 4 or 5 minutes total to fill in everything and subscribe to Simple Market Signals. A few points to remember with respect to your subscription to Simple Market Signals. Remember that everything is tied to your email on file. Now, once you subscribe, you will get an immediate emailed confirmation of your subscription. You will also receive an automatic welcome letter, so that's automatically generated from our system. And whether you see that welcome letter or not, I would encourage you to double check your spam, junk, trash, and promotion folders, especially for the first several weeks of subscription, because once in a while, our emails get automatically routed into one of those different folders depending on your email service provider, whether it's Gmail, Yahoo, whatever it may be. And I would get in the habit, I would encourage you to get in the habit of every week or two, just go out real quick and double check these different folders, the spam, junk, trash, and promotion folders, because I can't even tell you how many times I've had people say, well, I didn't get the email, and then when I tell them to go out and check those various folders, oh, there it is. So it's just, the reality of having an emailed service that once in a while, and it's going to vary from email service provider to email service provider, but once in a while, emails from us, depending on the subject line and other things, will get automatically routed into one of those different folders. Also, I would encourage you to whitelist all emails from Simple Market Signals. In other words, just make sure that your email service knows that you want all Simple Market Signals emails to go to your primary in basket. Also remember that newsletters go out on the weekend, okay? They generally go out Saturday afternoons, but they could go out anytime over the weekend depending on our production schedule. And the next new edition will be sent to you on the weekend following your subscription. So if you subscribe on a Monday, Tuesday, Wednesday, whatever it is, the next new edition is going to come out on that weekend following your subscription. But we will also send you the latest edition, so whatever the most recent edition of our newsletter was, we'll send you that latest edition as soon as we can, but we have to manually send that to you. Generally, you will receive that within 24 to 48 hours of your subscription. So again, if you don't see that first newsletter within 24 to 48 hours, go back and double check your spam, junk, trash, and promotion folders to make sure that it's not hidden in there. Also, within that first 24 to 48 hours, we're going to send you at least one or two emails with links to training videos that are for subscribers only. So please make sure that you're looking at all of this, because it's extremely important for you to get the most out of your subscription. Please watch those videos that are part of the training material that we send you. Now let's recap what you will get with your Simple Market Signals subscription. With your subscription, you will receive the weekly emailed newsletter, which goes out on the weekends, that will include all of the content that we just talked about. Plus, you will receive midweek update emails when warranted. So if there's a major signal or trend direction change in the middle of the week, we're not going to wait until the weekend to get you that information. We're going to send a midweek update email to get you that information as soon as possible. So again, a subscription to Simple Market Signals is just $19.95 per month. That's less than 67 cents a day. It's billed monthly on your credit card. There are no contracts. You can cancel anytime, and your first 2 weeks are free. To get started, just go to https://simplemarketsignals.com.